The IRS got a serious update recently. If you're a business owner, self-employed, or someone who claims deductions every year, you need to hear this. Because the way they review tax returns has completely changed, and most people filing this season have no idea what they're walking into. By the end of this video, you'll know exactly what triggers a closer look and how to make sure your return stays clean. Here's how it usually goes. You sit down with your accountant or you open your tax software. You start entering numbers. Home office, yes. Car, yes. Meals, yes. That trip you took in October, yeah, that was sort of for business, right? You file, you move on. And then life happens. Months pass, and one day there's a letter sitting in your mailbox with those 4 letters you never want to see. Not because you were dishonest, but because something in your return looked different enough to get a second look. That feeling right there, that's what we're trying to prevent today. Let's be clear about what's actually at risk here. An audit doesn't just mean answering a few questions. It can mean deductions wiped out, back taxes owed, not penalties stacked on top of that, and interest growing every single day you haven't paid. And it doesn't stop at the current year. If they find something, they can go back multiple years, same treatment. Here's what most people don't realize, and this is the part that changed everything. The IRS has always used a scoring model to rank returns. Your return comes in and it gets compared automatically against other returns in your income range and your industry. The more your numbers stand out, the higher your score. But recently, artificial intelligence made it dramatically more powerful. The system can now pull in data from outside your return. Property records, loan documents, public financial data. So what's actually triggering audits right now? Here are the top 7 red flags for this filing season. Red flag number 1, your spending doesn't match what you reported. Say you report 65,000 in income, but your mortgage, your car note, and your neighborhood quietly paint a different picture. The system picks up on that gap. Red flag number 2, your home office claim doesn't hold up. The home office deduction is completely legitimate, but it has real rules attached to it. The space has to be used only for business, not the dining room table you also eat at. A dedicated space used exclusively and regularly for work. Red flag number 3, your deductions don't make sense for what you do. Every profession has a typical pattern of expenses. When yours fall outside that, it gets noticed. Red flag number 4, you claimed your car was used entirely for business. Saying it was used 100% for business is a claim that almost never holds up. Personal errands happen. Red flag number 5, your business has lost money for several years straight. If you report losses year after year, the IRS starts asking, is this a business or a hobby? Red flag number 6, your meal deductions are out of proportion. Meals are deductible, but only at 50% and only with a documentable business reason. Red flag number 7, you wrote off a vacation as a business trip. For a trip to be deductible, business has to be the primary purpose. The majority of days need documented business activity. Imagine a freelance photographer. She made 85,000 last year. She claimed a home office, a vehicle, client dinners, and a trip to a creative industry conference. If she has a mileage log, receipts with names, and a conference schedule, the case is closed. If she estimated everything, she loses the deductions and pays penalties. The question I get most often is, if I take a lot of deductions, does that automatically mean I'll get audited? No. Taking every legal deduction is smart. Just document everything. The people who get through audits clean aren't the ones who took the fewest deductions. They're the ones who built a paper trail. Click the link below to book a strategy session.